You are listening to episode 59 of Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco, and in this episode, I'm answering a question from one of our fellow CMQ investors, Phil S.
Philly boy.
Hey, Franco. I just wanted to ask about your take on Charlie Munger buying the Alibaba dip. I'm having trouble understanding why Charlie Munger would double down like that when he's already lost so much on his original investment. Do you know what his thinking would be here? Thanks. Okay. I have a lot to say about this. So the last episode of the podcast, I explained why I'm personally bullish in Alibaba. And actually, since that episode, I continued buying more shares. And either the day after or 2 days after I stopped, the news came out that Charlie Munger had actually doubled down on Alibaba, in the previous quarter. So that news itself, it felt sort of validating, but I didn't think it was breaking news, and I didn't rush to make this episode. But then I realized, and this question helped me realize, that my, encyclopedia-like knowledge of Charlie Munger's investment approach makes this a non-event, because this was all very predictable. Now, if you go on Twitter right now, if you kind of look at what people are saying about Charlie Munger's decision, and even just based on Phil's question, there's kind of a consensus or sort of like a larger crowd that thinks that, Charlie Munger is losing it, or this is a terrible idea. What is he thinking? He's going to, basically like ruin his legacy and just, I could go on and on. But knowing Charlie Munger's, investment approach inside and out, his decision to buy more of Alibaba in Q4, and when I say he bought more, or I said he doubled down, he doubled the position in the Daily Journal Corp's portfolio of Alibaba. So I believe they had a little over 300,000 shares at the end of Q3, and in Q4, Charlie Munger bought another 300,000 shares. And actually increased the stake by 99%, which is just about as close to doubling down as you can do it. And in the previous quarter, just to give you even more context, I won't get into that. But let me explain to you why I think, first of all, this is entirely consistent with Charlie Munger's investment approach, and why, although we should never follow, even what one of our favorite investors is doing, why Charlie Munger is someone who, if you really know the ins and outs of how he invests, then I think his decision to buy even more of Alibaba is a real cosign that ought to be taken seriously. So let me bring it back to Charlie Munger's 4-step, I guess you call it filter, for making investments. So, and this is something that he's used, I would probably argue, since the 1960s. First, your investment needs to be within your circle of competence. You need to understand it. And that's something that, a lot of investors make the mistake of not doing. We forget the boundaries of our circle of competence. Next, you want to have a business that has, some sort of, durable competitive advantage. It has some intrinsic characteristics that give it a durable competitive advantage. Then you want a management in place that has a lot of integrity and that's very talented. And then finally, Charlie Munger has said that, even a wonderful business is not worth an infinite price. So you want to pay a price that's reasonable and that gives you some sort of margin of safety. So those 4 simple things. Now, some other things that I want to share with you about Charlie Munger's investing and his approach to investing over his lifetime. Charlie Munger is one of the most patient investors on the planet. He wasn't always this way, but he's willing to wait for years and years and let the cash build up and not do anything in search of what he believes is as close to a sure thing as you can find, where he can load up on it, invest, and not touch it, and just let the power of compounding do its magic or work its magic. And if you look at the Daily Journal portfolio, prior to adding Alibaba, there was only 4 stocks, and they were all purchased in 2013. So, a decent amount of time has gone by since he's added anything new. So this addition of Alibaba, and it's one of the largest holdings out of the 5 in the Daily Journal portfolio. He started buying in Q1, bought more in Q3. The price has only tanked since, and he's continued to buy in Q4. That's when he doubled down. Now, going back to Phil's question, why would he do this? Why is he buying the dip? Well, when Charlie Munger buys the dip, it's a lot different than somebody on Wall Street Bets just shouting, buy the dip, or Connor, the overconfident investor, saying, buy the dip, buddy. So when you factor this in, let me explain. Let me slow down a little bit. So buying the dip, right? Here's the difference of how Charlie Munger would buy the dip versus, probably the the way that the expression is used now. Charlie Munger's average price per share of Alibaba through Q3 was around $190. As he continued to buy more in Q4 while the price was just tanking, he lowered the average price per share to approximately $155. And this is according to whalewisdom.com. Now, in doing this, you could say he's buying the dip, but he's actually buying more of what he already owned and owned with a margin of safety prior to the price even going further down. So he was able to buy more for less than he already had paid, which effectively increases his margin of safety. So he's able to buy more and increase his ownership stake in a business that he believes, is very solid, has good long-term prospects, or as Warren Buffett might say, is going to have earnings that are materially higher in the next 5, 10, or 20 years. So knowing that when the price goes below the average price you paid, why wouldn't you buy more? Wouldn't that be the most rational thing? The problem is how, generally speaking, the investment world looks at risk and volatility. For Charlie Munger, the long term and the long time horizon is one of his X factors. When you're operating on a long time horizon, you're okay with short-term volatility. He doesn't have to answer to someone who after a year says, hey, my buddy got better returns than I got with you. What's up? Charlie Munger is buying something that he plans to hold for. I don't think he plans. I hate to say this, but I don't think he plans to be here for the ultimate result, right? He is the ultimate long-term investor, though. Furthermore, by loading up on Alibaba and doing so in a way where he's lowering his average price per share, he's effectively, as I said, getting a larger ownership stake in something that he thinks is great, and he's increasing his margin of safety, which reduces risk. So it's a double win-win. I know I'm kind of repeating that, but the reason this is so different than everyone else who says buy the dip. A lot of investors who piled into the market in the last year and a half, the tendency was to think that, stocks only go up, so buy the dip because it's only going to go back up. It's not how it works. It might work like that when we're in, practically, negative interest rates, which Warren Buffett, I'm going off in too many directions, but, as we're now seeing the Fed, talk about hiking up rates, we're now starting to see some pullback. And some of those names that don't have the same, let's say, fundamentally sound, that aren't as fundamentally sound, well, they start to lose a little bit of their, a little bit of air in the balloon goes out. And if you're buying the dip when you already paid too much and you didn't even consider the value of what you were buying, then, meaning like you didn't even bake in a margin of safety, well, then buying the dip just blindly is one of the worst decisions you can make, because you could be buying something that's still way overpriced just because it went down. That's not Charlie Munger. So Charlie Munger buying the dip means he's literally buying something for less than he paid for, something that he plans to hold for the long term. And this is the most important part. There's nothing that's changed with his initial thesis about the company. So all that bad news about Alibaba in Q4, and again, I'm not, I don't have a magic 8-ball, but, there's worries about delisting. There's worries about the VIE structure. Clearly, that's not a concern to him because he doubled his stake. And I think that's something that, again, I'm not saying that you should buy Alibaba because of that, but that's what buying the dip really is. That's something that in the Robert Hagstrom book, The Warren Buffett Portfolio, he talks about risk and how Warren Buffett would look at, a lower price as a buying opportunity. That's exactly what Charlie Munger, who, again, they're not the exact same, but they come off the same, fundamental principles, those 4 filters I started with. So think about this. Let me just cue this up real quick. It's a really hard answer because I have so much information on this, and it's like, let me tell you guys a few more things and tell me what's most interesting to you. So Charlie Munger doesn't buy a lot of stocks. I think that's another thing that people don't realize, except like a nerd like me who knows, his stuff inside and out. Charlie Munger has said that he made 90% of his fortune off of 3 different names. Berkshire Hathaway, Costco, and Lilu's fund. Charlie Munger is also the investor who, talked about subscribing to Barron's for 40 years and never did a single thing and found one idea in those 40 years, made something like $80 million, gave it to Lilu, who turned it into hundreds of millions of dollars. That's the kind of investor he is. He's looking for something that he can bet heavily on, where the odds are in his favor, and where he believes he has a true opportunity. Now, some of my favorite quotes from Charlie Munger, and these aren't just about investing, are about the nature of opportunities. These aren't direct quotes, but I don't need them. But the big idea is like in any life, the number of really great opportunities that we're presented with, it's not going to be tons, right? Like no one has a life where there's every day you wake up and there's just some amazing opportunity. Sometimes opportunities can come, when just I guess they can be few and far between. The really big opportunities that can change your whole life. So what Charlie Munger says is that when those opportunities do present themselves, the few times they do, you have to really load up. So when you look at what he's doing with Alibaba, and when you look at his approach to buying businesses, since really the 1960s, he's always been obsessed with finding great businesses. That's something that as he was learning, even learning from Warren Buffett, distinguished him from Warren Buffett. Charlie Munger would go around asking people, what's the best business you've ever heard of? He was obsessed with that. He was much less interested in the Benjamin Graham ideas and much more enthralled with the idea of buying one great business and just sitting there, because he recognizes the power of compounding and he realizes that it's just a lot less have a headache, to find one great thing and just not have to do anything else. But remember, and I want to add this, his style, while it's my favorite investment style, is not easy to imitate. One of Charlie Munger's superpowers as an investor is he's practically just desensitized to any sort of short-term volatility. A few Instagram lives ago, back in Q4, people were asking me, what do you think Charlie Munger's thinking about the current, price of Baba? He loaded up in Q3, and I said, and I didn't say it eloquently, but I'm like, I don't think he cares at all. I don't think he's even thinking about it. And I say that, and I say it confidently because that's literally how Charlie Munger has always invested. In his partnership that he had in the 60s, Warren Buffett described his specific approach as one that was, geared or kind of aligned with Charlie's psyche, which is concentration, highly concentrated. And he's willing to accept a lot more in terms of peaks and valleys in the short term because he has this long-term horizon and he really knows what he buys. Remember, starting with the circle of competence, you have to understand what it is you're buying. It has to be something you're capable of understanding. Charlie Munger understands Alibaba. He believes that the management in place is strong. He thinks the long-term prospects are good. He believes they have a durable competitive advantage. And he thinks over the long term, that Alibaba as a stock is going to have a high probability of achieving an above average return. That's the only time that an investor like Charlie Munger will ever buy an individual stock. He doesn't believe in holding baskets of stocks. He doesn't believe in just rolling the dice. He bets big when he believes the odds are heavily in his favor. I probably could have just made that the entire episode, just those last two sentences. That is Charlie Munger's investment approach. He does not care about short term. He understands the business inside and out, quantitatively and qualitatively. And so the fact that he bought the dip, he didn't really buy the dip in the way that people talk about it now. He bought the dip, meaning that he was able to buy or increase his ownership stake while lowering the average cost he paid per share, which only increases his margin of safety and reduces risk. Okay, CMQ investors, we're about to wrap up, but I just want to encourage you, if you haven't already, make sure you follow Compound Money Quietly on Apple Podcasts or Spotify. It's totally free. It takes, depending on how fast your thumb moves, shouldn't take you very long at all. And when you do that, you will always receive in your feed the latest episodes as soon as they are released. Once again, this is Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.